Yeah, we'll grab a water. Do we have water now?
Yes.
Okay, we're getting ready to get started, guys. I'm going to share the screen so everybody can see what we're looking at here. Can you guys hear okay online?
Yes, ma'am.
Yeah.
Can you guys hear okay online?
Yes, we can.
Yes.
Can you hear us?
Okay, I get thumbs up. All right, perfect. Okay. Make sure recording. Okay, you are good to go. All right, so guys, I'm going to take just a second. I don't know if all of you were at the mastermind at Pearls when Dominic came, but Dominic is my preferred lender. He works at Cornerstone. We've been working together for 6-7 years. It's been a long time. I don't know. So I met him pretty early when I got started, and quickly learned that his team will go above and beyond for all of our clients, whether it's a baby file for 100,000 or a $400,000 or $500,000 file. So I always like to get our people and my preferred people in front of you guys so that you guys can have just as good of relationships with our local vendors as possible. So Dominic's going to be here today. We swapped Monday and Wednesday for schedule reasons, but we're going to talk today about what happens behind the scenes. So we see everything that happens on our end, but a lot of times you guys don't necessarily know everything that's going on the back end that title's doing and that the mortgage officers are doing. And so we want you guys to be able to understand that process, because you're going to get questions from your clients on, well, why are they asking for this, or what is happening, or why is this taking so long, or clear to close, and closing disclosures and the length of time that has to happen between when a closing disclosure is received and when we can actually close. Your clients are going to want to know those things, and they're going to want to also hear them from you. So you guys have to have a basic understanding of what's happening on their side of the house, so that we can all be on the same team and work together. So this is Dominic, and he's at Cornerstone, and I'm going to let him take over.
All right, well, thank you, Nicole, for giving me the opportunity to come out today. As Nicole mentioned, my name is Dominic Dangora. I've been with Cornerstone for 7 years, and I've been a loan officer for 10 years. Fortunately, the last 7 years with Cornerstone have been a blessing. So today, what I want to talk to you about, as Nicole mentioned, is just kind of the back end process and some of the things that you may or may not know that happen once you send a client to us. So this is designed to be kind of an open dialogue. What's up, man? How are you? So if you have any questions while we're going, please don't hesitate to ask, and I would welcome those questions. So I have a team. It's kind of designed a little bit differently than maybe a real estate team. A real estate team would have maybe several producers, whereas on my team, I have myself as the loan officer, and then we have what's called client specialists. So this is somebody who would just kind of answer the phone, take the initial applications, and then once they get their application taken, they go to the loan analyst, who then kind of reviews their documents with a fine-tooth comb. So what we do in particular is a little bit different than most. We want to pre-underwrite the file before they go out looking for homes, right? So we don't want to waste your time or their time when they don't even particularly qualify. And we'll get a little bit more into that as we go. Client specialist, again, so she would lock the interest rate once it goes under contract. And then Austin and Troy, they're both closing coordinators. They kind of handle everything from closing, from contract to close. So everybody's role is specifically designed for each piece of the process to make it streamlined and really efficient. So today we're going to talk about the flow of a loan. So from pre-qual all the way down to closing. So we'll talk about what happens when we get the contract, when we submit the file to processing time, underwriting conditions, and closing. So pre-qualification. So what happens when somebody pre-qualifies is obviously they fill out an application, they give us their social, their date of birth, their income information. And then what happens is we'll review the app for qualification. And then upon review, we'll issue a pre-qualification. Okay, so I want to be I just want to touch base on the pre-qualification letter. Pre-qualification doesn't mean that they can buy a house. It just simply means that they have a qualifying credit score. So if somebody says, well, I'm pre-qualified, okay, great, are you pre-approved? That's really what you want in this market, because that means that the lender has then reviewed their documents and ensured that they can actually close. Pre-qualification is as good as the paper it's written on, and it's worthless. So client specialist will call to go over the questions that we have on the application to ensure that, you know, if we're missing any employment information, we can get that. And then the next thing is to set up an appointment with me to go over their lending options. So when they visit with me, the goal with that appointment is to go over their lending options, really help bring those numbers into focus, and make sure that they have all the information that they need to make a well-informed decision when the time comes. So we'll go over all their numbers, whether they qualify for DPA, whatever the case may be. I'll make sure that they have all of that when they're ready to go. So pre-qualified versus pre-approved. So pre-qualified is when a buyer finds out how much they might be qualified for. Keyword might. Pre-approved is when a buyer is approved for a specific loan amount, meaning that that lender has reviewed all of their documents like we talked about earlier. Any questions on the pre-qualification versus pre-approval?
So my question for you, I guess, is when you get a pre-qualified person, it's just credit score and then the information that they put in on the application as far as,
Right.
but you don't look at debt to income or any of that stuff
You
yet,
do.
or do you do it at a high level, you just don't get into it?
You look at all of that, but it's based on what they're telling you it is. So if somebody tells me they make
Right.
$10,000 a month, when it all comes down to it, you know, sometimes we've seen it as little as $2,700 a month.
Because of qualifying.
Right, because, you know, 50% of that could be overtime that we can't use, or per diem, if they work in the oil field that we can't use. So it just says, hey, based on what you're telling me, this looks good, but it's not verified at all. So you definitely want to take the extra step before you go out showing loans, making offers, that they've submitted all of their documents to the lender. Okay, so here's an example of a pre-qualification letter. The key right here is that it's provided verbally. So their income information was provided verbally. Their cash for the down payment provided verbally, and the assets were provided verbally. So what you want to look for when you're accepting offers or even making offers with your clients is that all of that is provided in writing. Now you can go make an offer on a home with this letter, but again, you could run into an issue once they submit their docs. Okay, so once a client goes under contract, the realtor would send us the contract, and at that point, that's when we select the loan program or confirm the loan program and lock their interest rate. We cannot lock their interest rate until we have a property address. There are some lock and shop programs out there to where you can lock the loan and then, you know, go out and shop for a house for up to 90 days. But there's a hit to the rate, and quite honestly, it's not worth it. So I don't ever offer it. Once they're under contract, we'll enter all of their information into our originating software. We then re-scrub the file and submit just a new email to the client with any necessary documents that we need. And at that point, we'll send electronic disclosures to the family via DocuSign. Okay, the electronic disclosure is about 30 pages of loan documents, and it just outlines the terms of the loan. So it's your loan application, your loan estimate, interest rate information, and then a bunch of legal documents that, you know, nobody really ever reads. And then at that point, we order the appraisal. So a little different with Cornerstone is that we don't use an AMC. Has anybody heard of an AMC before? It's an appraisal management company. Kind of a nightmare. So some of your bigger companies are going to use an AMC, or like national companies, if they're out of state, they use an AMC. So AMCs are just, there's not a lot of leeway. So if you're having an issue like getting an appraisal back or something like that, it's just a little bit tougher. So we have what's what we've just created as a pool of appraisers that we use here locally. And so we would submit an appraisal, and it goes into a pool of appraisers, and our approved appraisers will pick up the order. So it's just a little more lenient.
Do you have, when you were talking about like requesting documents
Mhm.
from the buyer,
Yes.
what, is it like from a realtor standpoint, is there anything that we can help? Because they always ask like, what kind of stuff we need to have handy.
Yes.
So when they're asking for stuff, what are you asking for?
I'm going to cover this here in just a little bit, but
Well, we can get to it.
okay, cool. All right, so when they go under contract, the next step is to get them into processing. So it goes processing, then underwriting. So once you submit a family to processing, we have to order any VOEs, VODs, flood certs, VOIs, and tax transcripts. So a lot of acronyms. So a VOE is a verification of employment. Whenever somebody makes overtime, bonus, commission, or varying hours, like a server at a restaurant, something like that, or tip income, we have to order this VOE, because what that does is it breaks out their income, commission income, whatever the case may be, over 2 years. And then we take that 2 year and we average. Okay. The VOD is a verification of deposit. Sometimes we use those in place of a bank statement. The flood certs, of course, self-explanatory. Evidence of insurance for the EOI, and then the tax transcripts. So tax transcripts are basically the tax returns from the IRS. So if somebody gives us a tax return, we're not just going to believe that that is their true tax return. We have to verify it with the IRS, and that's what most lenders will require. And we actually don't require those on W-2 employees, so oftentimes we don't have to order those. The next step is to order title work. So the title commitment, the chain of title, tax cert, wiring instructions, closing protection letter, and the title fees. The title commitment is important because we need to find out if there's any liens or judgments on the property. The chain of title, that's going to look for any deed transfers in the last 12 months. We're going to look for the flip rule here, the FHA flip rule. Anybody ever heard of that? Okay, so what can happen is a lot of times right now is you have investors that are flipping homes and then they want to sell it, of course, in a short amount of time. But if you have a client who's using FHA financing, just be mindful that you cannot close on that home until 91 days after that owner has been entitled.
And doesn't that also mean when can the contract be written? The dates on the contract? So we have had buyers go on, like we went and walked into a house that had been flipped, and we wrote an offer on it, it got accepted, and found out that they flipped it super quick, and we were at 75 days, and our contract, you have to rewrite the whole contract, and every signature has to be redone on that 91st day, and it can't go into underwriting. Yeah. Until then.
You can't have a contract date,
right.
Application date, all has to be on the 91st day.
Right. So if you could be 75 days. I've had this pop up because some lenders hadn't even looked at it until right before, like a week or two before closing, and then we realized that we had to redo everything, write in the contract, and then it was like another 2 or 3 weeks before we could close because they had to go through that whole process again.
So we're not typically going to look, you guys are going to know more about the property and whether it's been flipped or any of that. So kind of working together on that will be helpful because we're not going to have all that information. The way that we're going to find out is from the title company when they pull the chain of title. The tax certificate, you're just verifying the property tax amount. Wiring instructions, it's more for the lender. Closing protection letter that just states that the title company is going to just make sure that if there are any liens found post-closing, that they're going to protect this. And then, of course, the title fees. So one thing to be mindful of when lenders quote upfront, and I'll use myself as an example, when you get a quote from me, it's the highest it's going to be because I don't know who the title company is. I don't know who the appraiser is. So we just max out every fee. And then as we go through the process, if we don't need some of those fees, we'll either remove them or when we get the title fees from the title company, we'll adjust those on the back end. Okay, and then the processor is going to rerun the automated underwriting system and recheck the agency guidelines. So agency is going to be like your conventional FHA, VA 184. And then whenever you qualify for a loan, you have to submit the application, or the lender has to submit the application through what's called an automated underwriting system. So the automated underwriting system is a national system that every lender has to use. And what happens is you take the application, you take the credit, and you submit it to this AUS, and it reads it or analyzes it in 20 or 30 seconds and says yes or no. And so when you get the yes, that's when you can get the pre-qualification. So every lender has to use this AUS system to conform to the guidelines of Fannie Mae, Freddie Mac, FHA. And then the processor would coordinate with the team and the underwriter to clear the loan conditions. All right, so underwriting, the underwriter is really going to be the final say. So a loan officer can pre-approve, right? I can say, you know what, I reviewed all the documents and everything's good to go, but the underwriter is really going to be the final say. So just because somebody says they're pre-qualified or even pre-approved, again, that still doesn't mean that they can close. Not until that underwriter gives you the final clear to close. So what we'll do is we'll request the underwriting conditions from the family the same day. A condition would be like maybe an updated pay stub, bank statement, something along those lines. We'll receive the conditions back from the family. We're going to review all those documents, make sure that everything's good to go, get it back to the underwriter, and then resubmit the file to underwriting. So sometimes you'll hear clients say, well, I sent them all these documents up front. Why are they asking me for more? And that's common. And that's always going to happen, because yes, we can ask for the typical document checklist, but the underwriter might see something on there and say, hey, in addition to, I'd like you to get this just to verify X, Y. Or we might get a bank statement, and then on that bank statement, there's 5 deposits that we have to verify. And so now we have to go back, and then they give us something to verify those deposits, and there's more questions. So sometimes there can be a lot of back and forth, just depending on the documentation that's required. All right, closing preparation. So the closing department will then work with the title company to balance out all the numbers. So initially, when the client gets their loan documents, they receive what's called a loan estimate. Are you guys familiar with that form? So the loan estimate is basically I think it's 3 pages, I'm not sure. But it just kind of outlines the terms of their loan. When they get into closing, that loan estimate becomes a closing disclosure. So the LE, or the loan estimate, is the first document.
And that has to come out within how many days of getting contract?
The closing disclosure?
The initial one.
7 days.
7
So
days.
the quickest by law you can close a loan is 8 days. Because you have to wait 7 days by law, and then on the 8th day you can close. And I'm going to cover those with you here in just a minute as well. All right. So we'll work with the title company to create a preliminary and final closing disclosure. One thing with Cornerstone is that we will issue a preliminary closing disclosure in order to start the 3-day wait period. So before you can close, this closing disclosure has to be signed and received at least 3 days prior to closing, 3 business days. So you guys may have heard about Juneteenth becoming a federal holiday. That was a nightmare for lenders across the country, because they made it a federal holiday effective immediately. And it came out of nowhere pretty much. And so typically when that happens, because Saturday was no longer, well, let me back up. Saturday is typically a day that you count toward your wait period. But because it was Juneteenth, it became a federal holiday, and that day no longer counted. So everybody who had a closing disclosure signed and received, within 3 days to close on Monday, was no longer able to close on Monday, had to get pushed out to Tuesday. Now, granted, they came out toward the end of that day and said, hey, we'll make it 7. So everybody still got to close for the most part.
Hey, Dominic, I might have missed something.
All right. So
Can you
we'll
hear
send
me?
out a preliminary closing disclosure, and that'll give us time those last 3 days to balance with the title company, maybe get any final invoices from the realtors. If there's any home warranties that need to be added, we can then work that up. So that just gives us time. They'll get a preliminary closing disclosure. It's not going to be final. That just signed and receipted. So we get that 3-day wait period out of the way. And then we have the next couple of days to really finalize everything. All right. Okay, so once we have the final closing disclosure, my closing coordinator will email and pre-close the instructions and to the clients and the partners. So basically, when they close, we'll send them a final closing disclosure, a final closing email that has their closing disclosure and everything that they need to know for closing. We'll call the touch base, go over the closing disclosure with the family, and just make sure that everything is good to go, so there aren't any surprises at closing, the loan funds, and then we all drink margaritas. I'm trying to be funny there. I'm not doing good.
That funnier as you want.
Okay, so I threw just kind of some different slides in here that I feel like questions kind of arise from time to time, and we'll touch on some of the things that we discussed earlier with Nicole. So I want to talk about the interest rate and the APR. So the confusing part is if you get a credit card, there's just an APR. But when you get a loan, there's an interest rate and an APR. Okay, so on mortgages, obviously it's a loan, so you're going to have an interest rate and the APR. The interest rate is what determines your payment and your interest over the term of the loan. The APR does not do that. The APR takes into consideration your interest rate. So let's say the interest rate is 2.75. What it's going to do is take that 2.75, and then on top of that, it's going to add in select fees associated with the loan. So usually includes processing, underwriting, origination fees, if there are any, mortgage insurance, prepaid interest, and some closing costs and discount points. And what that does is it populates this annual percentage rate. And what that's designed to do is give you guys the ability as consumers to just compare different loan programs and determine what the cost of that loan is. So if the APR is 4% and the interest rate is 3%, you know you have some pretty high fees. Typically, you'd see something like if the interest rate is 3%, you probably see an APR around like 3.2. But basically, the higher the APR, the higher the fees. Lower the APR, lower the fees. Does that make sense? Any questions on any of that?
We do have a question
Sure.
from somebody online, and for some reason, their volume is not working.
Can y'all hear me? Can you hear me? No.
Lauren, you guys can hear us. If anybody online has questions, can you guys put it in the group chat and then we can ask it? Because for some reason the audio isn't popping up.
Yeah, Lauren put it on group chat.
I can hear Lauren.
We can hear each other.
Sorry, I'm just turning around.
Okay, so preliminary is 7 days and final is 3 days.
Correct. So Monday through Saturday count as days.
Monday
Sunday
through
does not.
Saturday, but that's for the
Federal holidays.
preliminary,
For both.
right? But what she's saying is when you have 2 waiting times, right? You
Yes.
have your preliminary from the time you get application, that's 7 days, and then you have 3 days. So how could you close something in 8 days if you have a 7-day and a 3-day?
You have to get the 3-day out after the,
Right away.
Yeah.
Almost back to back.
Yeah.
Gotcha. Okay.
we reserve those for emergencies only.
Sunday does not count.
Sunday does not count in the wait period for a closing well, for any of the disclosures.
Oh my God. Oh, TRR. Okay. Oh, okay.
All right. Straight APR. Okay. Another thing that you're going to come across is you're going to have lender credits and you're going to have discount points. And then you're going to have something called the par rate. So the par rate is basically the interest rate that's available at no cost and it doesn't give you a credit. But sometimes when you get an interest rate, it can give you a credit toward your closing costs. known as a lender credit. So let's say your closing costs are $4,000, there's a lender credit for $1,000, now your actual cost is $3,000 because the lender was able to give you a $1,000 credit toward your cost. Now, what happens is a lot of times what you'll see is, let's say the interest rate is 4%. Well, they said, you know what, I'm a little short on cash. Is there anything that we can do? Sure, we can bump the interest rate to 4.25, and now we can give you X amount of dollars toward your closing costs. That's what's known as a lender credit. That's available through any lender. So if your client is ever short on cash, and that is always an option to potentially help them, make up that difference. The other thing is paying points. So let's say the par rate is 2.75%. That doesn't mean that they can't get 2.5%, but they're going to have to pay money. They're going to have to pay what's called discount points or buy down the rate, is what you're going to hear it is referred to sometimes. So I logged in at 3.75 and paid 1 point because I wanted to secure a lower rate since I will have this loan for 30 years. Okay, 1 point doesn't mean that they went from 4.75 to 3.75. It means that they paid 1% of the loan amount. So a point is just 1% of the loan amount.
Not a true point.
Not a true point off the rate. So the rate might have been 4% and they paid a point to get 3.75. The market moves and these discount points and lender credits shift daily with the market. So if a lender credit is available for $1,000 today for that particular client, this afternoon, it might be $400 because the market got worse, or the market could improve and it could be $1,500. So points and lender credits move with the market. They always shift.
Okay, so with that said, we talk about like people locking their rate.
Yes.
Up front, right? You lock your rate. Once you lock your rate, if the market shifts, good or bad,
Yep.
You're locked.
That's correct. So the lender should be looking at the contract and determine the close date. Typically, you're looking at a 30-day lock. So you can lock 30 days, 45 days, 60 days, 75, 90, up to 270.
But the farther out.
Further out, the higher the rate.
Yeah.
And then as you get past the 90 days, it starts to cost money up front to lock. Those are what's known as extended locks. We typically don't come across that often.
So what happens if we have a contract and it's a 30-day close? You just wait a couple of days to give yourself some leeway to lock it? I mean, because with closing dates shifting, and what happens there?
So we kind of make that decision internally and just say, okay, well, if it's closing in 30 days, we'll always give a free 5-day buffer. I don't know if a lot of lenders do that, but we'll give a free 5-day buffer. So it's really, even though we lock it for 30, it's locked for 35. That's typically enough. If it goes beyond that, you have to start paying what's called lock extension fees. And lock extension fees are typically an 8% of the loan amount for another 7-day lock. So, it could be a couple $100, could be $600, depending on the loan. But you can always lock for another 30 days in 7-day increments.
Okay, we have two questions
Sure.
online. So the first one is regarding e-signing. And I know you guys allow e-signing on certain closing docs, but all of these docs that you have to get out up front to start the guidelines, is that universal? E-signing is accepted for those?
Yes.
And then, but then when we get to closing, pretty much everybody requires the documents for buyer and seller to sign in person, not e-sign.
Correct.
But you guys do allow part of the packet to e-sign.
Yes, so we do what's called an express closing. So we send a lot of the closing packet with the final closing disclosure for them to e-sign before they get to the closing table. So typically, I think it's maybe 11 documents that they sign at the table, maybe less with the express closing.
Right.
And the title companies love it, closers love it, families love it. They're at the table for less than 15 minutes.
But that is a Cornerstone specific thing. You still have to, so just keep in mind, no matter what, when you guys have a buyer or a seller, that they still have to sign wet signatures for closing. Buyers have to sign the day of closing, and sellers can pre-sign, but it still has to be an actual wet signature with the notary authorized by the title company. So either at the title company or a notary that the title company sends, no matter what.
So yes and no.
Some lenders started
The remote
the
online,
remote
yeah.
online, yeah.
So that's gaining a little more traction. It did through COVID, but basically what it was, is you could sign everything online. And then there was maybe 1 or 2 documents that still needed to be wet signatures.
Right, but you still have to have something that's wet signed, so we're working through that. Just plan for anytime you have a closing, that all parties need to be prepared to sign at closing, or have an authorized power of attorney to sign on the other's behalf.
Oh, is that how like out of state investors are getting around having to come in state to sell?
Well, no, I mean, I close with people out of state all the time. If they are a buyer, then their lender has worked something out for them to be able to sign, or if it's cash deals, it's a little different. Because cash deals, they can overnight the docs here. Or if it's a hard money lender, they don't have to go through the federal guidelines to do all the necessary federal guidelines that you have to follow for conventional FHA VA. For sellers, they can be anywhere in the world. We send them a packet, get a notary coordinated, and it has to be a title approved notary. Send it to them, they sign it in front of the notary and overnight it back. So it depends on how they're paying for it and if they're the buyer or the seller, but we still need to get signatures. And so if you know your seller's gonna be out of state, we need to plan for that up front to get them the docs, get them signed, get them overnighted, and be back in time for the buyer to be able to sign them in person.
Yeah, there's typically, when you do a remote notary, like if you're in Arkansas, and you send somebody to you, just keep in mind that they need to sign the day before and have those overnighted and back to the title company, the originals, in order for them to fund. So if you're gonna close on Friday, that person really needs to sign those documents on Thursday and overnight to the title company
At the latest,
at the latest.
yeah, because
We always try to do those 2 days in advance, especially if you ever have one in Alaska, just FYI, it's not gonna be back in 24 hours. It'll be 48.
And then I have another question online. Does a lender need to wait until possible DTI issues are sorted out before ordering an appraisal, or how soon can you order the appraisal, especially with the long lead times that we're seeing with appraisals?
So I can't speak for every lender, and that might be a lender specific requirement. We typically order the appraisal upon receipt of the contract. We want to get it ordered immediately. But typically with the way that our process is designed, we're trying to deal with those issues before they go under contract. So hopefully we don't have a DTI issue. I mean, it happens. Things always happen in this business. But I wouldn't not order appraisal just because there was an issue with DTI if I thought that I could solve the problem.
Another thing we're seeing, and I've seen this in some instances, is where, and not so much in this insane market, but I've seen, and there are some lenders that have flat out said, we're not going to order the appraisal until we get the go ahead from the buyer's agent that everything's okay with the inspection. Now, that can be very problematic. And so one thing, and it's part of you guys' checklist that we created for you guys in command, it's part of what the transaction coordinator does, but you guys need to be very aware of is, as soon as you go under contract and get that file to the lender, you need to check with the lender on when the appraisal due date is and make sure that it's been ordered. And if you get something that says, hey, we're not ordering it until then, that's a red flag. We need to escalate that, because that, I mean, appraisers right now are backed up. We just got one that's in FHA. We have the seller and they won't, and we were supposed to close June 25th, this Friday, June 25th. And that we can't even get the appraisal back until July 8th. And that's on a rush because it was FHA and they say they can't, I mean, it's a nightmare. But you need to check these things, and we check this the first week into the contract to try to push for changes, but this lender won't change it. So you need to make sure, as soon as you go under contract, you're asking, has the appraisal been ordered? What is the appraisal due date? And make sure that aligns with your contract. And if it doesn't, try to escalate. In this case, we can't make any changes unless they change lenders. Because they're a national lender and they just don't have the connections with local appraisal companies and appraisers to get things expedited.
That's a great example of an AMC. So that's an appraisal management company. And so that's a situation where they don't have any pull. Like
Yeah.
they can't say, hey, you know what, can you please go out and do this? The family's trying to close on this date. Whereas we do have the flexibility. We send, these appraisers a lot of business and they appreciate that. We appreciate them. And so sometimes when you need a favor, they'll, pick up the date.
I mean, this is very important to understand because this example that we're dealing with is with Bank of America. Bank of America has a huge budget. They nationally can advertise. You see this with Wells Fargo. You see this with Veterans United, USA, Navy Federal, all these big banks that have this billion-dollar marketing budget that have that can just get business from anywhere because of that, right? They don't rely on their customer service and meeting deadlines and closing on times to stay in the business. Because they just will throw more money at it, run another ad on TV and continue to be able to create loans. And they don't care if they piss off Joe Smith in Oklahoma because they can't close it for 2-3 weeks after the closing date. If they piss him off, it's not even a blip on their radar. If Dominic screws up a loan, it's a big blip on his radar because he is dependent on his service in this market. And he doesn't have $1 billion budget to throw at it to go get, to go get more business. So when you see on these real estate forums, like we're not even looking at offers that don't have local lenders and reputable lenders, that's why.
Yeah, so our business is all word of mouth referral, you guys, and past clients, and builders, so we have to do a good job every single time.
I just had one down the day, that the appraiser, and it was, 2 weeks, past their closing, it was that, they worked it in, they didn't pay the extra, they came out, they worked it. So we did that, they put the job.
Yeah.
So that helped me.
But that's the difference in having a local lender that has a local underwriting, who has local appraisers in their, not in their pockets like that, but like at their disposal to be able to say, hey, I need a favor, I need you guys to get this done quickly. Do you think the Bank of America person even knows who this AMC is, who even knows who this appraiser that it's assigned to fix it? No.
You have lost in the crowd unless you have local money.
And you're going to see things, especially in the market we're in right now. Rates are starting to go up a little bit. And and this is kind of off topic, but since we're kind of talking about, I'll bring it up. Before the pandemic, a lot of lenders and banks were about to go on. They couldn't sustain the cost to originate a loan is like $8,500. And that's on the lender's side. The average cost to originate a loan, about $8,500. And so there just wasn't a lot of revenue coming in. And then all of a sudden the pandemic hit and now rates went super low. And now all of these companies, it was like a life preserver for it because they can pick up the business through refis. Well, now that refis are starting to drop off again, the business is slowing down and all these companies that had 80-90% refi business, now that business is gone almost overnight and they're kind of in that same predicament. So you might start to see some of that trickle effect happening more and more as we go. But what I wanted to mention is you're going to see like the Bank of Americas or the big conglomerates are going to be offering these crazy deals. Like, I don't know, it's like $7,500 toward closing costs at a low interest rate. The reason they have to do that, they have to because they can't get business any other way, right? Unless they just spend billions on their marketing. There's not repeat customers per se for Bank of America. Most realtors are not going to send their clients to Bank of America to get free, unless they just don't know. So you're going to start to see people who are uneducated in the sense where they're just thinking, well, I can get $7,500 and I can get a low interest rate. Why wouldn't I do that? And the reality is because you're probably not going to get your offer accepted. And if you do get it accepted, it's going to be hell. So I've seen 3-4 months
That's what
with
we're
Bank of
dealing with
America.
right now, because this person needed that the $7,500 lender credit to be able to close.
Yeah,
They're doing down payment assistance and for their down payment and the closing credit.
which is fantastic. It's like, when
It's
it
not
closes,
fantastic when
it's-
they can't even get the appraisal until 2 weeks after.
that's what I'm saying. It's like you have to, if there's like a little give and take. So you have to educate buyers that just because it's a good deal doesn't mean that it's gonna work. They don't understand that, you know, lenders differ and that, you know, who they choose as a lender could impact their decision to accept their offer. So, all right, can we touch on everything on that?
Yeah, and I will tell you, I had a multiple offer situation on my listing yesterday, and the best offer was a Wells Fargo pre-approval, and I went to them and I said, we want your offer, but we will not accept it with this current lender. Will they go to a local lender? And they are actually switching to Cornerstone to do their loan, because there was just no way in a multiple offer situation that we were willing to, when we had another one that was kind of close with, it was with Cornerstone too, that we were even gonna consider a Wells Fargo pre-approval. Because you're not gonna be able to talk to anybody, you're gonna get a call center, you're never gonna get answers. And you can tell, like, when you call there, you pass around, you never talk to the same person twice, and it's a nightmare when you have issues. And you absolutely can do that, or just not accept those offers when you're on the listing side.
Okay, so there's 4 pieces that we look at when qualifying somebody: income, debt, assets, and credit. The reason I wanted to show you guys this is because all 4 of those are required to be able to qualify. Somebody, you'll hear sometimes, well, I'm putting 20% down. Does that help? What if I put 50% down? Does that help me qualify? Well, no, if you don't have income, you know, somebody could have $3 million in the bank, but they might make, you know, Social Security, right? So that's common, retirement. Not common, but it's something that we see. And so really, unless they take some type of asset distribution, they can't qualify. They can buy the house for cash, but if they don't have the income to qualify, then it's not going to work. So those are the big 4 pieces. We have to have income. Down payment doesn't matter. It's not like a bank where you can just say, okay, well, I'll put 50% down or whatever, and they'll agree to that. We have to adhere to strict federal guidelines, and DTI, we were talking about that earlier, that stands for debt to income ratio. The debt to income ratio can exceed certain max percentages. We'll talk about that in just a minute, but it's very black and white on our side. So we have to adhere to those guidelines. Okay, so for income, we're going to look at 2 years of employment history in the same field. Doesn't have to be 2 years in the same field, but it's preferred. We're going to look at salary, hourly, commission, self-employed, or other employment. If the buyer has fixed income or Social Security, something along those lines. And if the buyer is claiming child support or alimony as income. So those are the primary sources of income that we're going to be looking at. For debt, so the debt to income ratio is the percentage of the buyer's income that goes toward paying the monthly debts, including the new mortgage payment. So sometimes you'll have clients that are calculating their debt ratio, but they're not including the new house payment that they're buying. What counts as a debt? So anything on the credit report, we're not looking at utilities. We're going to be looking at auto loans, credit cards, student loans, mortgage payments, any credit cards, IRS debt payments. That's a big one that can sometimes catch you at the end if the lender doesn't ask up front. If you ever have a self-employed borrower or buyer, the lender should be asking if they owe the IRS any back taxes. And it's pretty common. So definitely want to take care of that because that can prevent you from closing.
And the mortgage payment is not just the principal and interest,
Taxes and
it's the
insurance.
taxes and insurance too, it's the entire payment.
Mhm.
And that's why we talked about this in class a week or, well, right before you guys had a post license. But that's why we talked about like making sure if, you know, when you're looking at these things, getting them to get insurance quotes right away to make sure that that's not going to cause any problems, because taxes are pretty straightforward on existing homes because they're already published. But insurance can vary depending on insurance carrier, and it can change the payment by anywhere from $30 a month to $150 a month. And so making sure we have that figured out is very important.
And then sometimes somebody will have a mortgage payment on their credit report from another home that they own, but that mortgage payment might not include taxes and insurance. So if the lender doesn't ask, does this payment include taxes and insurance? And then, they get into underwriting, that could be another thing that could trip you up and prevent you from closing. So
What's considered like a good or a bad DTI? Like where's the line that we need to like when they start? I mean, I guess they're not going to do that with us, but
Yeah.
like for instance, when you're going through that whole process.
it ranges per loan type. So anywhere from 41 to 56.99 per loan type. So
VA
A
is the
good-
most flexible, right?
VA is the most flexible. VA doesn't really have a max. They look at something called residual income, and they look kind of a total big picture. But I've gotten VA loans approved at 72%, which is pretty nuts. But well, the reason I was kind of smiling is because what's good and then what's like normal are two
Right.
different things.
Okay.
And most people are at the 41 to 56.9, but what's good is probably below 30%. But we can't deny somebody, and I can't tell them like, hey, you shouldn't do this. They're gonna buy a house. Here we are, 41 to 56.99% DTI. So each loan type has a max debt ratio. So on a 184, which is your Native American loan, the max debt ratio is 41%. USDA, which is going to be like your rural loan, so kind of outside of the metro, it's going to max out at 43% and up to 50% with compensating factors. Compensating factor would be like if they've been on the job for 2 years, or stable, or maybe let's see, good credit, credit over 700, something along those lines. Conventional can go anywhere from 45 up to 50.49, as long as it's under that 50.5. And then FHA is 56.99. And as I mentioned, VA does not have a max.
So that's calculated by like if you have $1,000 of income, then 500 of it is going to just interest or loan payment. That's a
Yeah, so if you have $1,000 and you have $500 in payments, you'd have a 50% debt ratio. Yeah, but then what you have to do on top of that is include the new house payment. You see, so if you have the house payment, then they're not.
right.
Okay, I wanted to throw this in here because what you're gonna find is that people are gonna go into getting pre-qualified thinking that their credit is one thing, and then they go to the lender and they find out it's another thing. So what they're experiencing is just a different scoring model. So Credit Karma, for example, is a consumer credit model. If you go get an auto loan, that's an auto scoring model. Credit, let's see, consumer, auto, insurance, you're gonna have a different score. Of course, a mortgage is gonna be the most strict of them. So what happens is you go on Credit Karma and your score might be 720, and then they go to the lender and the score is 660. Well, the mortgage report is going to pick up everything that they've ever done. Whereas Credit Karma might not pick up a medical collection that they had from 3 years ago. And so that derogatory account is not going to be picked up in the score. So it's going to provide a more favorable score on Credit Karma. So that's an example. There's several different examples, but that's just to give you one example there. But Credit Karma is not used for mortgages ever. So just keep that in mind. We see it anywhere from 100 to 120 point difference often. Any questions on that?
So if you have somebody who's trying to improve their credit, so even if they do qualify, but they want to be better, so because their credit rate or their credit score impacts the rate that they get as well.
Yes.
So what would you recommend they do, or where do you recommend they go to monitor?
So what we do is we do what's called a credit simulator. So I don't give that task to them. We have an in-house software that we use, and so every credit report is going to be different. So one thing may not work for the next person. So we kind of have to look at it on a case-by-case basis. But we'll run the simulators and we'll kind of take out accounts or pay down accounts and just determine what's going to be best, the least amount of money with the most amount of impact. And so sometimes we have to, delete accounts, and that would require them to go to credit repair, something along those lines. Getting medical collections deleted. So sometimes you can get what's called a deletion letter. This typically only happens with medical collections. They tend to be the most lenient. But if somebody has a medical collection, and this happens often, they just show up on your credit report because maybe the bill got sent to the wrong address. Nobody ever called. Happens all the time. If you call into that creditor or that collection agency and say, hey, if I pay this $60 medical fee, will you delete that from my credit report? And it's a 30-day process, but sometimes they'll provide the client with the deletion letter, and then that deletion letter can be sent to the lender. The lender can then kind of do a rapid rescore, which removes it in 5 to 7 business days. But to answer your question, it's different for everybody. Sometimes it's paying down debt and deleting accounts, or sometimes it's just going to credit repair.
Okay, but if you're just a consumer and you
Yeah.
want to look at the best, where's the best place to go that's gonna be the most similar to the credit report that you're for? I mean, I know Credit Karma is not. What is? Just with the credit bureaus themselves?
Yeah, the annualcreditreport.com or whatever that is. That would be the best one. But that only pulls it from one bureau. So we pull from the 3 major bureaus, Equifax, Experian, and TransUnion, and we take the high score, the low score, and use the score in the middle to qualify. So I don't know that there is a model that's similar to the mortgage report. I do like Credit Karma, it's really quick on updating, like in terms of inquiries and accounts being added or taken off. I just don't like the score. It's always gonna be higher, but I don't know if there's one that's similar to the model that we use. That's accessible by the consumer. Okay, assets. This is the most frustrating part in the process for most people. So assets going to be their checking or savings accounts, eligible gifts from the family, life partner, future spouse, or government agency, and then 401k. The reason this is the most frustrating is because the federal guidelines require us to verify basically every penny that's used in a mortgage transaction. And so if somebody sends us their bank statements, there's typically something on there that we have to verify or source, and then it just creates this chain of documents. And sometimes buyers, if they're not, if they don't have the documentation or have trouble getting it, it can become very frustrating for them. But we have to verify it. Again, it's all black and white. We can't bend the rules there, but we have to verify that they have the funds for closing. Okay, so I wanted to talk about some credit requirements. So we call this the 11 commandments of credit. Why are you awake? Well, probably been standing in your way the whole time. Okay. So thou shalt not change jobs. So you never want to change your job or become self-employed during the process. That will disqualify them almost immediately. You don't want to buy or lease a car, truck, or van. Don't want to use credit cards excessively or let the accounts fall behind. All of this seems really self-explanatory to us, but it happens all the time. So you don't want to omit debts or liabilities from the loan application because we're going to find them. We will always find them. Don't buy any furniture or appliances until after you close.
Number 6 is big.
Yeah, people
Like,
always
I gotta get a
ask.
refrigerator. As soon as I move, I've got to have it at closing. It's got to be delivered that day. Well, if you're gonna buy it, make sure you're not using your reserves
Yeah,
and make sure you're not putting it on credit and messing up your debt to income.
yeah. I always just say if you can wait. You never want anything, because what happens is the underwriter is going to do a soft pull on their credit within 10 days of closing. And so if any new accounts have been added or balances have increased, that can affect their debt ratio and or their score, which then could affect their interest rate. And then there's just a chain of events that can happen from there. No new inquiries on their credit. Don't make large deposits without checking with the loan officer. Cash, I don't know if you guys know this, but cash is not an eligible source of funds, oddly enough, in a mortgage. Sometimes people have $10,000 in their bedroom, and they want to use that for closing. It's very difficult to use that if they just go deposit that money into a bank account. So just if your clients ever have cash, or if you hear anything them talking about making large deposits, always encourage them to check with the loan officer on the best course of action for that.
I mean, we had a deal where one of our clients sold rims off of their car. Remember that one?
Yeah.
Yeah, and you have to have a bill of sale, and that bill of sale has to be then sent to the lender, because they're gonna see that $3,000 deposit, and they're gonna wanna know where that money came from, and you're gonna have to show the bill of sale, they're gonna approve the bill of sale. So even like selling stuff on Facebook Marketplace, you could sell an appliance, if it's an unusual deposit, you have to source it. And you have to be able to have a bill of sale to show that it was legal money that was deposited.
Everything has to be verified. Okay, don't change bank accounts or overdraw your checking account. Don't co-sign a loan for anyone. And don't change your name during the home finance process. So again, if you have somebody getting married, just have them consult with their loan officer to determine whether they should close in their maiden name or their married name, just depending on when they can get their social security card updated. Okay, so this is kind of the basic documents that we ask for on every loan. So we're going to look for the most recent 60 days of bank statements, most recent 30 days of pay stubs. If they have a mortgage or a home that they're going to retain, then we need that mortgage statement. If they're going to use any retirement funds, we want to look at the brokerage statements, the W-2 forms, driver's license for each applicant. So even if the spouse is not on the loan, still need their driver's license because they're going to be untitled. Retirement statements, let's see, personal federal income tax returns for the last 2 years. Sometimes people just try to send us like the first page of the 1040. They say, well, everything's on here, you can just use that. And I'm like, no, you can't just use that. We need all pages, all schedules of every tax return. Homeowners information, homeowners insurance information, if they do have a mortgage, or if they already know who they're going to use up front. So in addition to, there's probably always more documentation than we need, but this is going to help us to pre-approve them up front. All right, so the loan estimate disclosure, or loan estimate and closing disclosure turn times. So the loan estimate, the buyer gets this within 3 business days of applying for a mortgage. So once they go under contract and we have that property address, the loan then becomes a formal application. So we have to disclose a loan estimate within 3 business days of getting that contract or entering that address into our loan originating software. The closing disclosure, the buyer gets this 3 business days before closing, and then a redisclosure. So anything like a redisclosure would be maybe you change the loan amount or you change the loan term. We then have to redisclose. And the first disclosure package is about 30 documents, as I mentioned earlier. The redisclosure package is just a few documents. Something that could change or require a redisclosure would be if the APR is higher than an eighth, or if they're changing the loan product or adding a prepayment penalty to the loan. Should never add a prepayment penalty to the loan on a conventional or FHA or anything like that. So it shouldn't ever be an issue. All right, so this is, let's see here. So if you're closing on Monday, your closing disclosure is due the Thursday before. Okay. Same thing, if you're closing on Wednesday, you need it signed on Saturday. Tuesday, you need it signed on Friday. So basically, it's just Monday through Saturday count as eligible days. And the closing disclosure just has to be signed and received 3 days before closing. And federal holidays are excluded. Okay, so something we started doing a little bit differently with our pre-qualification letters to help our clients win their offers is we kind of just spruced up the pre-qualification letter and we added a cover page and then the pre-quals in the middle and then a closing page. And basically this is just kind of reminding the agents who are examining the offers that we do everything in-house, processing, underwriting, closing, funding. We're just kind of giving them a little bit more information, telling them who we are, and then just letting them know, you know, we'll have a smooth process throughout the team or throughout the process, and kind of our in-house support team. So Again, if you're submitting offers to your families, this one just sticks out a little bit more and provides a little bit more information. So we found it to be helpful with a lot of families, and their offers have been getting accepted. Loanfly is just our online. It's our app. Everything that we do can be done on the app. They can submit their documents just with their phone. They can take a picture of it and upload it. And that's pretty much all I have for the process. You guys stayed awake. I appreciate that. Isn't this fun stuff that we do? What questions do you guys have for me?
I got one. I received a pre-qualification letter from you guys on one of the previous listings, but it had, in addition to, it had the quoted, qualifying insurance rate.
Insurance or interest?
Insurance.
Okay.
It had a reference to the insurance. From what I was told is that because it's on that letter and part of the pre-qualifying documents that they had, basically up to the day of closing to get that insurance. If they did, they had the option to break the deal as disregard to everything else according to the law. Just because the insurance thing on the pre-qualifying item for the loan qualification.
So is your question, why do we put that on there, or you thought that it was unfair to have it
Well, from what I was, how it was explained to me is that because it was on there, it gave the buyer the option to negate the deal up to the day of closing.
So if it's a pre-qualification letter, what I would have done is we put that on there to protect us. So when we pre-qual the deal, that means that insurance has to be that or less, otherwise it doesn't qualify. Right. And so,
But that's like that with anything,
yeah,
period. And regardless of if it's on the letter or not, if any buyer obtains insurance and it pushes them outside of the debt to income ratio, they will not qualify for the loan, period.
and
So
then
it
it falls out due to financing.
Right, and that's on any, no matter what, whether it's in the letter or not.
So we just put that on there to
But you
protect
had
us.
multiple offers, Matt, and that one was, you put aside and said, this isn't something that you want to deal with, because
Right.
when you're feeling.
Yeah, it was actually the highest and best offer, but because of the the financing requirement that.
But that's a financing requirement for every single one that's in there that's getting financing, period. Right, because
He's saying that it was on that letter and it wasn't on the others.
just because it's not on the other letters doesn't mean it's not a requirement. It's a because every single person that's obtaining a loan, period, has to obtain insurance. That insurance becomes part of their monthly payment. Their monthly payment has to fit within their debt to income ratio. So if they don't obtain insurance at a certain dollar amount, if it's over that, and it pushes them outside of that debt to income, it will automatically bust through financing no matter what. It's a requirement for every single loan. It doesn't make that one any different.
Right, I was just saying, I'm just bringing that up, to just make everybody aware of the situation.
Right, but what I'm telling you is that didn't make that one any more risky than any other one that was in front.
I see where you're coming from on that. Again, that's just for us, so they know, like, this is really, really tight. You cannot get, if you get it higher than this, then it's not gonna qualify. But I see where you're coming from. But I also,
As the listing agent, it's like, well, I'm not gonna touch that. But if I was working with the buyers, like, how can we clear that, sooner and get that before you're sitting at the offer, saying something that's.
What they're saying is you're not.
You can't.
Well, I know, but not before,
Yeah.
but set a timeline on getting it cleared, saying, hey, this is gonna be, this requirement of the law is that by.
Right, well, they have to verify insurance as soon as possible. I mean, they have to get their insurance done and set up and get through underwriting as soon as possible. So you can't get your insurance the very last day because it has to go through underwriting. You have to show proof of insurance and get that cleared. I think it was just the way it maybe was written wasn't super clear. But there are cases where insurance is cut. The good thing on that is a buyer can get cheap insurance pre-closing to meet those requirements, and then can go change the insurance after they close to a better insurance that maybe at a higher rate they choose to. So they might just have to, for closing purposes, pick an insurance that has lower coverage but meets the requirements. And then change that insurance after the fact to get better coverage if they choose to do. Without messing up their loan and busting their loan. But all I'm trying to say is that's always gonna be a requirement to have insurance that falls within the debt income amount.
We just the only difference is we specified that particular thing, because that would be the make or break situation. If it didn't come in at that price or lower, then it would have busted. And so, again, what you're saying is it doesn't matter, it's part of the financing, fell through due to financing. So whether we notate it or not, it's still the same thing.
And
We just
it's
notated
based on every single, anybody who's obtaining a loan that is required to include, they're not putting enough down to where they have to escrow insurance and taxes. It has to fall within those parameters.
Correct.
Right.
Well, I'm sorry you didn't accept the deal.
Yeah.
You still got margaritas.
What other questions you guys have? All right. Well, if you guys need anything, I'll give you my card. And then you have my info. On foreclosures? Yeah, what you got?
So a friend of mine found on
Hey,
Zillow
bro.
a house.
You're supposed to stick around, that's all this is gonna be.
You ever reconsider?
I'll put that, I can put that out on our, campus.
So a friend
Yeah.
of mine found on Zillow that have been-
Can you speak so we can fit online and hear your question?
Sure. So on Zillow, there's a house that's been listed as pre-foreclosure for 241 days. So, and it's empty. So why is it pre-foreclosure for 200 and some days?
Foreclosure process can take 6 to 18 months sometimes. It's a long process and it's different on every single one.
So it's technically not on market yet?
Pre-foreclosure is not on market. And technically something can show up as pre-foreclosure. When Zillow pulls something and marks it as pre-foreclosure, all that means is they missed one payment. It could never go into foreclosure. It could never become available. They could have missed one payment and now they've paid it and caught back up. But because they missed that one payment, it will show up.
The neighbors, it's been empty for months and months, so I
Hmm.
guess it just sits there until.
I'm not certain. I mean, for financing, we wouldn't look at it any differently. It would be something on the real estate side that you guys have to deal with, but in terms of financing, whether it's in foreclosure, pre-foreclosure, doesn't matter necessarily to us, as long as the other lender is willing to release it.
Are you seeing more foreclosures right now? in the market or no?
No, and I believe that there are any, if we do start to see some of that, it'll, like I said, it'll probably be another 18 months before we start to see some of that.
Forbearance.
Yeah.
So,
The forbearance deal, how long was that in effect for?
I don't know how long it's in effect for. That's a good question. I don't know the end date on that. I
When
know
they
that we're
will
seeing a
stop,
lot less of it now.
right?
And the cool thing is with that forbearance, they were just rolling the missed payments or the skip payments onto the back of the loan, which was not common. So that was a huge help. So like, there's a lot of talk about, potential foreclosures or increase in foreclosures. But this time around, we've got people with a lot of equity, we've had a lot of appreciation. We had the forbearance, which allowed people to skip payments. And then they don't have to pay it all up front in a one lump sum like they had to in the past. They can just roll it into the back of the loan. So I don't think that we're gonna see a lot of.
Everyone can do that.
From what I understand, yeah. From everyone that we've seen.
Just roll it to the back and continue with payments.
Yep.
And then just make the-
Extend your loan out.
Exactly.
The amount.
Yeah.
Time you have.
Pretty cool. I mean, it's a great feature.
What happens to the taxes and the insurance? That's why they didn't still pay that?
Well, that's what, every bank has been different, right, on how they're handling that, because some are paying it on their behalf and then tacking it on at the end.
Right,
and collecting
right.
it.
So it'll still be paid out of the escrow and then the bank will just put it on the back. Monsoon out there.
I know.
You guys have any other questions?
For people that work, like cash or how does that work with financing?
Typically it doesn't. You have to have it documented somewhere on like a 1099 or a W-2 or on tax returns. You know, if it's not, if you can't verify it, then you can't use it, unfortunately. So people who get paid under the table, they can't unless they get some other type of alternative
Yeah,
financing.
private financing.
If it's been in the account for longer than 2 months.
You can use those funds. Most loan types only require a 60-day seasoning period. So, you know, if somebody does have a bunch of cash and they're not going to buy for a few months, we always recommend they deposit it and then let it season. So if it's been in there for 2 months, then it should be good.
That's only if they're using them, I mean, if they're using those funds. But if they're getting cash as a form of payment to use as qualifying income, it doesn't matter.
Are you
You
talking
can't-
about just using like verifying assets or are you talking about using income?
Sure, or if like, if you're getting ready to try to do something like that, you should probably start making $1,000 deposits every week.
Yeah.
You still have to show what are those deposits coming
Right.
from.
Yeah, so we're gonna have to show where they came from. Any non-payroll deposits have to be verified. So like in the example I mentioned earlier, somebody has $10,000 under their bed. They want to put that in the account, let it season for two months. But if they continue to make those $1,000 deposits each week, then we're gonna have to show where those
Where
$1,000
that
came
money is coming from.
Yeah. Now, sometimes in a situation like that, if somebody, like some people are inside banks, and so they'll go cash their check and then take half of it and put half of it in the bank. So if we can show that they've done that over the last 12 months or however long, and they've taken $1,000 out of their paycheck, and then all of a sudden at the end of the year, they've got, you know, let's just say it's $40,000. We can source that they took out $1,000 every week and saved it up, you know, that we can match that, but more often than not, that's not.
And like I said, if you had somebody that had $10,000 and they can potentially use that for funds to close down payment as long as it's been seasoned for that
Right.
60 days. But it can't be used as qualifying income.
Right.
It could just be used as cash to close.
Yep.
So there's like, if they made
Or
$10,000 a
even
month,
a large down, down payment, closing costs, all that stuff can come as long as that money's in season for at least 60 days.
yes, but it's not qualifying income
Income,
as far as their debt to income ratio.
Yeah, because they'll have them with.
Right, source those funds.
One thing I'll mention is on FHA, this changed, I think, in the last 12 months or so, maybe a year and a half, but if you have somebody getting a gift, doing an FHA loan, the donors, so if your mom's giving you $10,000 for closing, you're doing an FHA loan, you need your mom's most recent 30 days bank statements. That is a huge issue with a lot of donors, because they're like, wow, I'm not even on this loan.
And then if there's unusual deposits on theirs,
Then we have to source.
we talked about this at that class as well.
Yeah.
Right, if you're getting gift funds, they have to provide their statements, and then they have to source anything unusual on theirs as well.
That's where it can start to get frustrated for people, because I agree, like, why do we need the donors bank statements, but that's an FHA report.
Well, what if they're getting money illegally? right? You
Right,
can't
well,
use
exactly.
I mean, there's reasoning behind it.
Yeah, of
It's
course.
just, right. But it could just get, I mean, I see a lot of people get very frustrated because the parents don't want to do that. They're elderly, they're anti-bank, they don't feel like people need to be in their business. But anytime you're bringing your business into a transaction like this, it has to be verified.
All right, guys. Well, if you don't have anything else, you guys have my contact information. Please don't hesitate to reach out. I'd love to be a resource for you guys.
Perfect.
Thank you.
Thank you.
All righty, have a great day. Stay dry. See you next week. Take care.
Okay, we're gonna take just a 10-minute break and then we're gonna hop right into contract with Pam. And we're gonna pick up where we left off last time with the inspections period.
If he's gonna take higher, if that's something he wants to comment on, you wanna find one? So, you know what I mean?
No,
Yeah. I mean, there's plenty of rules on there. I mean, if there is, anything, tomorrow, I mean, there's just no way that. I mean, the only other thing you could do is get something now and then refinance or recast if he's gonna have some cash to save up. I mean, if he's on a conventional loan, he can buy now and then save for a year and then pass that loan to lower his payment. I mean, there's lots of different options, but I mean, there's just no way to say what's gonna happen.
Okay, so this weekend I have these people that I was talking to. They, so the son got a loan from the parents. And the parents are gonna buy the house, but through the son.
Okay,
The parents do not speak, don't speak English at all.
the son's getting the loan, he's buying the house for them.
Yes.
Okay.
So the parents don't speak English. And so the son got a realtor, and since the realtor could not communicate with the parents are like, we can't, you know, because they're, you know, communicating with us and they want to keep the house and stuff. So I spoke to him a couple days ago. This is a report from a friend of mine. I spoke to him. I said, okay, so I have to sign it. And he was like, no, I haven't signed it.
Even if he did in that
So-
case, because he can't serve, they just say, we're not comfortable.
When I went to see him, I asked him, did you sign anything? Like, no, he was like, he just sent me this thing because we like this property, but they were not comfortable with, but we were gonna put it in offer for this. Well, 2 days before that, he sent the Vibro agreement and he signed it for a year.
It doesn't matter.
Doesn't matter. They can still break it.
All we have to do is if that agent wanted to try to take them to court, all you have to do is say, hey, there's a language barrier, we're not comfortable, we didn't understand. Like that's why I always say those buyer broker agreements are really not legal, like they're more of a setting the expectation type conversation than an actual defining document. Any buyer can go back and say, this agent wasn't taking care of my best interest, we didn't work together, I didn't feel like they were available, they didn't speak the same language, I mean, you could say anything.
Okay, so in that situation, I can take him.
Yes,
Because when I spoke to him, he's like, I'd rather do this.
right, and that's
And
all
they
we
were
have to do.
excited,
Yeah.
but I was like, I want to get.
No,
Let me find out.
all you
where-
have to do is, they have, if that agent pushed it, just say they're non-English speaking, and they felt that they could not be serviced to the extent that they needed to.
Never know anything.
Go get the sign, we're training, I got my buyers, you service that too, and then 4. So how long class can be in the next week?
This one's gonna be an hour, and then we gotta end at 11:30 because we have, the lunch, thank you.
Okay.
Who's that with? What are we doing?
That's just with the staff and with some of the ALC, and it's gonna be in here. It's just a kind of know who's who, meet the leadership team, just for a chance for you guys to meet and engage with people outside the program.
I think also in that video, she said they want to talk about things from last week that not the whole thing. Discuss the notes that.
That's
were taken.
tomorrow.
That's tomorrow.
That's tomorrow. is
Yeah.
that- That's
Or
lunch.
Thursday.
Yeah, that's another day. That's something a little
Is that
different.
another lunch too? Or-
I think that's just you, if you wanted to bring a lunch, it's at lunchtime.
Are they providing lunch today?
Yes.
What are they?
I don't know.
Too many lunches.
What is going on outside?
I tell you what, we need to get my signage outside of it.
Yeah.
Okay.
Okay, well, I mean, if it's pouring down raining, you can get it after that too. They'll be fine.
This is the only-
Okay.
this is the only thing we need.
What?
You got one on two.
Are you trying to? Okay, so go back to.